So now let's proceed with the previous topic, accounting for assets and liability. And if you recall, the last thing we discussed was provision, contingent assets, and contingent liabilities. Yeah, so we have to start now with handout page 31. After reporting period or the subsequent event. That's under IES 10. So what we mean by after reporting period? After reporting period. Now, reporting period, now this is where, now for example, let's assume if the financial, if this was the start of the financial year, so that means that financial year will end on 31st of December 2023. Now, when will you prepare a financial statement? Or when does the company prepare their financial statement? 31st, eh? Yeah, so that means the accountants don't break for Christmas, right? Yeah, we don't prepare the financial statement at the end of the year. No. What happens once the year ends, or when the financial year, let me use the word financial year, not just the year. Once the financial year ends, the entity is given 1 to 3 months. So be given 3 months, maybe up to March, so that you prepare the financial statement. So we don't prepare the financial statement at the reporting date. Are you together? Reporting date, that's when the financial year ends. Once the financial year ends, the company is given 1 to 3, because preparation of financial statement is not a one-day thing. It's a series of things. Then from there, you have to call the auditors. Before the financial statement are authorized for issue, you call for AGM. Now, this period now, after the reporting date, that's the end of the accounting financial year, up to the date, the financial statement are authorized for issue, so that now you can hold your AGM. Now, this is what after reporting period, or what we call the subsequent period. Good. Now, what happens? Now, during this period, we need the financial statement for this financial year ended that 1st of December 2023, either to be adjusted or not be adjusted. Now, that's what now ISN provides for. If you have the reporting period or subsequent events, those events are classified into two. The subs events and then we have non-adjusting events. So now you're saying that these events are classified into two. So we have adjusting events. Events, they are those events that happen after the reporting period, before the AGM, but before the actual statement are authorized for issue, which provide more evidence, which require the adjustment of the financial statement. Non-adjusting, they are those events that will happen after the reporting date, which are indicative but does not require amendment of the financial statement. So therefore, what are those? Good. So now, for example, let me ask you a question. For example, this period, there was a debtor receivable. The company sold goods to customers, and the customer was to pay after 1 month. So that means high chances the customer will pay in January. Now, once customer pays in January, you see now in another financial year, that is year 2024. But you see now, our customer has paid maybe in January, but now that amount, that amount relates to the goods that had been sold for this financial year. So that means that debtors will adjust as the customer year 2024, and that's 2023. Also assume that good on credit to your customer, and then your customer in January was declared bankrupt. The customer was declared bankrupt during this financial year. But you see, in this case, the debtor that was declared bankrupt related to the transaction that had taken place in this financial year. So what will that happen? Let me give you a scenario, for example. Assume that your debtors was 3 million at the financial year. So this is your account receivable. Those are your debtors. Then a debtor that owed the company 1 million was declared bankrupt in January. Remember, you're holding your AGM in 3 months' time. That is in March. Now, will you tell that your shareholders that now there is amount we're expecting an amount of 3 million, knowing very well you will never recover the 1 million for the debtor was declared bankrupt? Now, that means in that case, what will happen? Even if he was declared bankrupt in this financial year, remember, transaction related to this financial year, they need to adjust, assuming that the bad debt will be 1 million. So this 1 million need the financial debt for this financial year to be adjusted. That is 1 million to be taken as the bad debt. Therefore, it affects the income statement. Also, the account receivable, which is part of the current asset, was 3 million, need to be adjusted downward to 2 million. Good. So now let's discuss on that. So events after the reporting period. Now, these are events that take place between the balance sheet date. Now, balance sheet date is the reporting date. And, but before the AGM, And there are 2 types of events. Which are those events? So number 1, we have the adjusting events. And what are the adjusting events? Now, there are those events that take place after the balance sheet date. Balance sheet date, we are saying that is the reporting period. So we are saying that there are those events that take place after the balance sheet date, providing additional evidence. Can you underline additional evidence? Underline that, additional evidence. Yeah. Providing additional evidence of conditions that existed at the end of the reporting period. And how do you account for them? These events need to be adjusted to the financial statement. Underline that. Underline that. That they need to be adjusted to the financial statement. Good. So what are the examples of adjusting events? 1, bankruptcy of a debtor after the reporting period need debtor's amount to be adjusted by reducing. Number B, recovery of debt that has been previously been written off. Assume at the end of this financial year, you had a debt of 100,000 from one of the customers. A debt written off. The customer has said that I won't pay and they'll never pay. And then in January, he decides to pay. So how will you treat that amount? There was a debtor who had said that I'll never pay. So that means the amount was already written off as bad debt. Bad debt. Then after 1 month, they changed their mind. They decided to pay and you recover the amount. So how will you recognize that? Bad debt recovered? As a what? As an income, correct. So bad debt that was already written off. It's, for example, you give someone a debt. Now has been 2 years. So that means you even forgot. And then you tend to meet with that person and tell you, but by the way, remember your debt. How much was your debt? To assume Waliomoka. And then he pays you your full amount 2 years ago and you had forgotten. So how will you treat that amount? Okay. I'm trying to give you a clue as an accountant. How do you treat amount that was written off, you had forgotten, and then you recover it? Receivable. No, it's not receivable. As an income, correct. Then number C, sales of inventory after the reporting period may give evidence about the net realizable value of the inventory. Yeah, that means at the reporting date, you had some stock inventory. And now listen up here, because this one will be tested in your published financial statement. You had inventories. That's what we call the closing stock at the reporting date. And then after 1 month, they sold that stock. So that means this. Now, the sale was made in this financial year. So that means the sales, remember we recognize sales when earned. Are we together? So that means the sales will be for year 2024. But we have sold stock that we had purchased in this financial year. So that means what you need to adjust in this financial year is only the adjustment of the closing stock. Are we together? Adjustment of the closing stock. But the sales will not affect for this financial year. The sales, we recognize them when earned. Then number D, discovery of fraud or errors that shows the financial statement are incorrect. Yeah, mostly you come to realize those errors once you call the and then they come to realize that there was fraud that had happened in this financial year. So what does that mean? In case there is fraud that happened, that means there is a lot of adjustment need to be done to the financial statement. Therefore, it needs financial statement to be adjusted. Number E, settlement after the reporting period of the court case that confirms the entity had an obligation at the end of the period. Confirmation of court case. Yeah, remember we talked about provision. You see that provision is a liability. Assume this company, there was a pending legal case in November. And then the judge decided that the verdict will be done coming next year in February. And then the judge confirms the case 2024. But now the question is, this case related to which financial year? 2023. So in case there's a verdict here, so that means it will need the financial statement for this financial year 2023 to be adjusted. So those are examples of adjusting events. Yeah, mostly they check about the current assets. What about non-adjusting events? What are non-adjusting events? Now, these are events after the reporting period that is indicative of condition that arose after the reporting or after the end of the reporting period, which need not to be adjusted to the financial statement. Can you understand that? Which need not to be adjusted. Need not to be adjusted. So how do we adjust for them? But they provide more, but they do not provide more evidence. So they include, now what, which are those non-adjusting events? They are those events that will happen after the reporting period, which requires no amendment to the financial statement. You just need to make a disclosure. 1, decline in the market value of investment after the reporting period. Number 2, change in the tax rate after the reporting period. Also, announcement to plan to discontinue an operation. Also, declaration of dividend after reporting period. Also, the destruction of a major asset. In case you want to know the non-adjusting events, what you need to know is only the adjusting events. So I have given you the adjusting events. There are 5. So if you get any other event which does not fall under the adjusting event, therefore they are an adjusting event. And most of the adjusting events mostly touch on the current assets. Things to do with the non-current asset, most of them, they are non-adjusting. Now we look at the accounting treatment of subsequent events. How do you account for them? We have already mentioned that in case it's adjusting events, you need to adjust the financial statement. In case it's an adjusting event, no need for the amendment of the financial statement. What you need is just a disclosure. So you're saying that, number 1, we're looking at accounting treatment. Number 1, adjusting events requires amendment of financial statement to incorporate them and a disclosure of the nature of the subsequent event and material impact. Number 2, for non-adjusting events, do not require amendment of the account, and only a disclosure note is required in the notes to the account. Good. Take out your past paper. September 2021, question 1. Yeah, September 2021, question 1, 1A, 1A. September 2021, question 1A. In the context of IAS 10, that is event after the reporting period, justify your answer, justify your classification of the following events as either adjusting or non-adjusting events. Number 1, major business combination after the reporting period. Business combination. Is it adjusting or non-adjusting? Non-adjusting. Number 2, major dealings in the company shares. Non-adjusting. Number 3, resolution of court case against the company for damages. That is adjusting. Number 4, destruction of a major asset by fire. Non-adjusting. Number 5, bankruptcy of a major customer. Adjusting, correct. Yeah, because bankruptcy of a major customer, that's all about the debtors. Number 6, expropriation of asset by the county government. You might not be understanding what that means, but does it fall under what I have given you as the adjusting event? No, so therefore automatically becomes a what? Non-adjusting. Good. Let's go back to our handouts. Yeah, we're in handout page 31. Then we look at prior period errors. So we are done with the subsequent events. So now we look at prior period errors. Yeah, what do we mean by prior period error? Now, prior period error, this is where assume that your reporting date was 31st of December 2023. Now you are the chief accountant. And then you started working for this company as an intern. Now 3 years ago. And then you realize that 2021, company acquired an asset. They acquired an asset. And that asset, the accounting policy is that you depreciate on a straight-line method. But you made a mistake, you used a reducing balance method. Then also assume that the value of the asset acquired was 4 million. But you made a mistake. Instead of 4 million, you recorded how much? 3 million. So that means your financial statement, because they could have understood that you are just an intern. So you make some errors. And in that company, you are the only one with the accounting background. So that means even the director could not even notice. Then after 3 years, you come to notice that there is a mistake I had done. So how will you rectify that? Because remember, this value which was wrong, remember the closing balance for that financial year becomes the opening balance for this financial year. Then that year you accounted based on the wrong figure. So the closing balance is wrong will still be carried forward. When you notice that, how do you account for it? Now, in case there is any prior period error that was omitted, so in that case, you need to rectify that using what we call retrospective application, whereby you adjust the opening balances for the only affected item. Now, for example, for depreciation, what will you adjust? Number one, depreciation is an expense. Also, that means the value of the asset, the value of the PPE, that means also the value of but mostly we focus on the statement of financial position. That's the balance sheet. Because if you start to adjust the income statement, you'll do a lot of adjustments. Because if depreciation was wrong, what will happen to your profit? Profit was wrong, right? If your profit was wrong, what happened to your retained earning? It's wrong. Are you getting? Yeah, so in that case, mostly we focus on the statement of financial position item. You apply retrospectively. You need to adjust the opening balance of the affected item. So now let's go through that. That a prior period, a prior error is an omission from or a misstatement of prior period financial statement. Such error must have been caused by the failure to use or misuse of the information that was available when the financial statement were authorized for issuance and that could be expected to be have obtained. E.g., mathematical mistake. Instead of 4 million, you record 400,000. What do you call that error? Instead of 4 million, you forget about 1 0. Is it error of omission or commission? Eh? Omission. That is? So therefore, this is an error. Co or o? Just say omission. Omission. So is it co or o? Yeah, commission. What about when the amount should be 110 and then you hit 1. Reverse. You are reversing 1 and 0. You need to be familiar with these errors. Go and research on that. That one I won't remind you. So now let's go through that. So e.g. mathematical mistake, wrongful application of accounting policy, as well as misinterpretation of the facts and the figures. So how do you account for this prior period error? Now, a prior period error must be corrected retrospectively in the financial statement. Can you underline that? Retrospectively. Retrospectively. Yeah, that's transposition error. That's very correct. Now, someone is saying here, instead of omission, they said I had seen transportation. Transposition. So you're saying that prior period error must be corrected retrospectively in the financial statement. Yeah, retrospective application means that the correction affects only the prior comparative figures. So we are done with that. Now we look at the government grants. That one is under IAS 20. Government grants, that's under IAS 20. What do we mean by a grant? Now, grant and donation, they have similarities, but they are different. So what could be the difference between a donation and a grant? Don't tell me spelling. What's another difference? Okay. Donation have? The grant have condition. Yeah, while donation have no code. Correct. That's the difference between a grant and a donation. Donation and grant, both of them, they are assistance from the government, not just the government. Also, you can see from another party. But now donation, there is no condition attached to it. But for grant, they have specific condition. Good. So how do you account for grant? Now, IAS 20 provides two methods of accounting for government grant. One is the capital approach. And number two, we have is what we call the approach. By the capital approach, it requires that the amount of grant to be recognized outside income statement. That means you take it as part of the equity. What about the income approach? It requires the amount to be recognized to the income statement. Now, for example, this is something you have been seeing mostly for the government. For example, a case of KQ, whereby even if they make a loss, the government will always bail them out. Mumia Sugar. They receive grant almost every year, every financial year. The tea farmers. Okay, let's just work with factories. Also, some schools you receive from a government, either from CDF or that. Now, how do you account for this? For example, a KQ receives some bailout from the government worth 2 billion. Now, as a chief accountant, how do you account for it? Now, IS20 now is the one that's paid how you should account for these government grants. So now let's go to that. Saying that these are assistance in form of transfer of resources to an entity in return for the past or future compliance with certain conditions relating to operating activities of the entity. Therefore, what is government assistance? Is an action by the government designated to provide an economic benefit specific to an entity. Can you underline economic benefit? Economic benefit. So they are tailored to bring an economic benefit to an entity. Government grants may be in form of an asset or an income. Then you have what we call forgivable loan. What is forgivable loan? Like, for example, if you have listened to our finance bill, they say there is amount they have had set aside to pay for the debt that the farmers they owed to, I don't know, to who. So that means the company or the farmer, they had some debt their company had taken. And now the government decides to bail them out to pay for that debt. So what do you call that? See, that's one of my explaining. Okay, what am I explaining? What am I explaining? Yes, and you find that one in an exam. So how do you account for government grants? Now, there are two broad approaches for accounting for government grants. One is the capital approach, and this requires the grant to be provided out of P&L account. They should be recognized as part of the equity or capital in the statement of financial position because no repayment is expected. Grant is not a loan. Is an assistant, but now subject to what? Subject to condition. Then number B, another approach we can use is the income approach. Now, grant should be provided in the P&L. How do you recognize it? Yeah, as an income over one or more period. This is the recommended method because government grants are earned through compliance with their condition. They should be recognized as an income over a period the entity benefit from such grant. Now, when should you recognize a grant? Because there is a difference between a promise and a fulfilled promise. So when the government promises you something, as an accountant, there is a time you need to recognize, and sometimes you assess. You see that what you are being promised, that's just a promise. So there are some conditions for you to recognize that. So now let's look at that. Circumstances under which government grants should be recognized in the financial statement. Number one, when the entity is certain that they will comply with the condition attached to them. Number two, when certain about receiving what? The grants. If you are not certain, the probability is less than 50%, don't recognize them. Are you together? Yeah. And then number three, when the value of the grant can be measured what? Reliable. Yeah, because if you have to recognize the grant, you need to recognize them in monetary terms. So that means if you have to recognize in monetary terms, you must be able to measure the value reliably. Good. So we are done with IAS 20. Now we go to IAS 21. No, we'll come back to IAS 21. Now, IAS 21 is all about the effect of changes in the foreign currency. Meanwhile, we look at IFRS 5. Now, IFRS 5, it's all about discontinued operation for non-current assets held for sale. Also, the discontinued operation. Now, kindly don't confuse non-current asset held for sale with what we did under IFRS 9. What did we discuss about IFRS 9? I told you that this standard should be at your fingertips. What did we discuss under IFRS 9? Financial instrument, correct. And a financial instrument, this is a contract that gives rise to an asset to one party and a liability to another party. Then we also discussed about the financial asset, and you see that financial assets are classified into three. One was the financial asset at fair value through P&L, financial asset at fair value through OCI, stroke what? We said it's also known as what? Available for sale. Now, don't confuse that available for sale and non-current asset held for sale. Now, let me ask you a question. A motor vehicle in a company, is recognized as a what? As an asset. Which category? Non-current asset. Now, what's the difference between a non-current asset and the current asset? What's the period? Now, I want that period. Okay, what's the current asset? You can skip all that, then you tell me what you want to say. Less than a year? Good, I know that's what you wanted to say. What about a non-current asset? More than a year? Yeah, correct. A current asset is an asset owned by the company of which the entity expects the economic benefit within one financial year, or an asset that does not expect to be in the company for more than 1 year. An asset that is expected to be in the company for more than one financial year is what we call a non-current. So therefore, we agree, a lorry or a motor vehicle is a non-current asset. What if now, during this financial year, we decide to sell that motor vehicle? The management is committed to sell that motor vehicle. Now, does it meet the criteria of an non-current asset? First of all, I've taken you back to the definition. Have you understood the definition? Yes. For an non-current asset, expected to be in the company for more than one financial year? Yeah. Now we have committed to sell this motor vehicle within the next 2 months. Does it qualify to be a non-current asset? Now that's what we call a non-current asset held for sale. So therefore, what happens? IFRS 5 provides that in case there is any non-current assets, but now the management have committed to sell it. That means they don't expect to utilize it to earn more benefit, but now they expect to get cash flow through the sale. It will be classified as an non-current asset. So what happens? You declassify from being an non-current asset, you recognize it as a separate item under the current asset. So under the current asset, now that's when you recognize cash, receivable, inventory, then you recognize this non-current asset held for sale as a separate item. You get that? It's all about you change the classification to a current asset. Then how do you measure it? When you are recognizing it, it should be recognized based on the ROA of the carrying amount. Now the carrying amount is the same as net book value, the cost minus depreciation, and the net realizable value. What do you mean by net realizable value? Now, for example, assume that you have a motor vehicle. The cost was 4 million. Then there is accumulated depreciation of 300. So that means how much is the net book value? The net book value is 20. Now this 25 is what we call the carrying amount. And then we have decided to sell it now. Based on the current market rate, the highest bidder, how much is he offering? And then you find that you have like 3 bidders. They want that asset. But the maximum they can give, the one giving the highest, they're only giving an amount of 2 million. You see, the carrying amount is 25, but the net realizable value, what you can recover now, is also known as the recoverable amount. The maximum you can recover is 2 million. So in this case, what will happen? When you are recognizing this asset as current asset, you recognize based on the ROA of the two. So how much do you show as the value of the asset? 2,000, correct. But its carrying amount was how much? 25. Now, that difference of 500 is what we call impairment loss. And you take it as an expense. And once you classify your asset from a current asset to a current asset, don't depreciate until you sell. Right together? Don't depreciate it. So you recognize it based on the ROA of the carrying amount and net realizable value. And in case the carrying amount is more than the net realizable value, the difference, the impairment loss, which should be recognized as an expense. I will go back to our notes. Now, these are assets whose carrying amount should be recovered from the sale transaction rather than through continuous use. It should be presented as a separate item under the current asset. It's valued at the ROA of the carrying amount and the recoverable amount or the net realizable value, the ROA of. An impairment loss should be recognized when the carrying amount is greater than the net realizable value. And then non-current asset for held for sale should not be depreciated, even if it's still being used by the company. Now, what are some of the conditions to be met for an asset to be classified as held for sale? There are some conditions that have to be met. Number one, that the management is committed to plan to sell the asset. The management is committed. That means we go to the minute book, you'll see that the director have already approved that. Number two, the asset is available for immediate sale. Then number three, the active program to locate potential buyer has been initiated. Not just saying they are selling. They have said that we are selling, and they have started to advertise for sale. So we are saying that there is an active program to locate a potential buyer. Then number four, the sale is highly probable within 12 months, in short, within 1 financial year, from the date of classification as held for sale. Good. Yes. Fair value is the market value. Fair value is the market value of us. Actually, they're almost the same. Because if you are to sell now, you see, the willing buyer is willing to buy based on the current rate of such an asset. But also, why do we call it net realizable value? The fair value can be 2.3. The fair value can be 2.3. But remember, there are those who does this work. For example, in a given village, if you want to sell your cow, you might be difficult to get a buyer, but there is someone who will tell. They are known as the brokers. Broker, they have more information. Are you getting? So the company want to sell, and the buyer is taking 2. The buyer, the highest buyer, is willing to give you 2.3. But for you to get a buyer, there is someone who connected with the buyer. Those are the brokers. Are they paid? Good. Let's assume now he'll take 300,000. Now this you minus 300, that's what's called the net realizable value. Also, this recoverable amount, we call it as fair value less cost to sell. Fair value less cost to sell. And when you translate that, you go back to the net realizable value, because what the company will get is 2 million. So they are kind of the same. Good. And now we look at the impairment. Impairment of assets, that's provided for by IAS 36. Now, what is impairment? Impairment and depreciation, they are almost the same. And it's that, what is depreciation? You have to admit that. What is depreciation? Is the loss of value of an asset. But we see that for tangible assets, they depreciate. For intangible assets, we say they are amortized. Right together, amortization. Therefore, what is impairment? Impairment also is the same as loss of value. Now, what's the difference? You see both of them, they have the same definition. Is the loss of value of an asset. What's the difference? Depreciation is the loss of value as a result of usage. You are utilizing that asset. What about impairment? Is the loss of value due to other factors other than you buy an asset, you use it, it depreciates. I ask you a question. If, for example, you buy a phone, 20,000 shillings, you bought a phone today in the morning, worth 20,000. Then you decide to sell it after 1 hour. After you realize that you have not paid your casino fee. Can you sell it at 20,000? High chance you cannot recover that. Are you getting? But have you used the phone? The phone is still new. So you have not utilized the phone. So that means the phone has no depreciation, but the value have reduced. Now that's what we call an impairment. Yeah. You see that an asset is said to be impaired when the carrying amount exceeds the recoverable amount. An asset is said to be impaired when the carrying amount exceeds the recoverable amount. Now let me take you back to this scenario. The carrying amount of this asset was 25. But the maximum you can recover now, you cannot recover a maximum of 2,000. So when the carrying amount exceeds the recoverable amount, that's when you recognize an impairment loss. Yeah. So now let's look at indicators of impairment loss. How do the company assess that there is an impairment? So indicators of impairment loss. So they are classified into two. We have an external indicator and internal indicator. One of the external indicators is significant decrease in the asset market value. Then a significant change in the, with adverse effect. Adverse means negative effect. Yeah, significant changes with adverse effect to the entity's asset, such as technological changes, market, and legal environment. And then number three, increase in the market interest rate, and those increase are likely to be affected or to affect the discount rate used in calculating an asset value in use. So we shall discuss this one now as a whole topic with calculation in our advanced level. So we'll come to explain more about that. Then we have the internal indicators. One, physical damage of an asset. Number two, evidence is available from the internal reporting of inefficient performance. Now, when this asset is not performing the way you expected. So that's an indicator. Good, then impairment reversal. We'll go through that. So now let's go to the other page. Group of revenue. So let's take a small break. So now let's proceed. Revenue goes under IS 18 as well as IFRS 15. In case you're getting the revenue from the contract to the customer. So what do you mean by revenue? Now, revenue is any income that you earn from day-to-day operation. That means, for example, as a school, we as KCE, what's our revenue? Fees. What about for insurance companies? Premiums. What about for the banks? Deposit is a liability. The interest on the loans. Are together? Yeah, the customer deposit to the bank is a liability. Yeah. When they give you a loan, to them that loan becomes an asset, because that asset they expect to receive the income. Good. Now, revenue is the gross inflow of economic benefit during the period arising in the course of ordinary activities. Can you underline ordinary activities? That's what we call day-to-day operations. So revenue only includes the gross economic inflow received or receivable by the entity on its own account. What does that mean? Now, that information is very important. It might look to be a statement, but it's not just a statement. For example, assume that you buy a book from a supermarket at 100 shillings. That means you pay 100, right? So to the supermarket, it's an income, right? But what you buy from the supermarket, the amount was inclusive of VAT. What is VAT? I know it's value-added tax. So I'm not asking what VAT means. What is VAT? Yeah, it's not a bit. VAT is a tax on the value added. Are you together? Is a tax on value added, which to a supermarket is not an income. VAT is a revenue to the government that is collected by registered trader. Not everyone collects VAT. It's only collected by the registered trader. When do you qualify to register for VAT? When your annual revenue is approximately, at least 5 million, or also you can also apply for what you call voluntary registration, but you have to convince the commissioner. Yeah, because once you collect that, their money, they're supposed to collect and then you remit. So they have to trust you first. Right together? Yeah, so that means, assume that of these 100 shillings, 16 shillings was the VAT, value added tax. Now, how much should now the supermarket or this shop recognize as their revenue? Because this 16 shillings is not their money. They have collected on behalf of the government. So that means their revenue is only an amount of how much? 84. So the only amount you collect in your own account, any amount you receive on behalf of the third party. Now, for example, give you another case where there is what we call principal agency relationship. For those who are paying rent, who do you pay rent to? For bank. You pay to that or agent. Let's assume that you live in a residential house where you pay, they have an agent, right? Who do you pay to? Agents, right? Now, and when you pay that amount, does it go to the landlord or the owner of the property, or first of all goes to the agency account? Agent, correct. Now, this is what I mean. For example, that means that you have an agency, and from a given residential house, you collect 500,000 shillings in a month. You know, the tenant will pay this amount, not to the landlord, to your account as an agent, right? And then you collect all the revenue, you have agreed that you need to remit this money now to the owner. So what happens? You're on a commission basis. Let's assume that you earn a commission of 15%. 15% of that is how much? 50 plus 25, that's 75,000. Good. So 75,000. So now I want to ask you, how do you account for this? Now, the revenue to be recognized by you as an agent. Yes, in your account, you have how much? 500. But this money is not yours. Right together. It belongs to the owner of the house. Your money is only the commission, an amount of 75. So when you recognize an income, this is recognized as an income, but this one is already cash at bank. Cash at bank. You recognize it as an asset because you already have the liquid cash, right? But of this liquid cash, 75 is your income, That means there is a balance of how much? 425. What about this 425? How do you recognize this? You already have it. You have recognized an income of 45. There is a balance of 425. You need to account for it. Because this is what I mean. You'll debit cash at bank with an amount of 500,000. You credit the P&L or the income statement with an amount of 75. Then there is a balance of 425. Myran and Fred, which other account you credit with the balance? Commission. Yeah. Can you discuss? 10 seconds to discuss. Now, after discussion, you're combining your thinking capacity. What have you discussed? It's a liability? Liability, that's very correct. This is a liability. How does it? We did this when we are doing the professional firm. Do you remember when you're doing professional firm? When there is cash you are holding on behalf of the client, we are recognizing it as an asset because you already have the cash. But remember, this money does not belong to you. It belongs to another party. Another party. You recognize it as what? As a liability. Yes, you have the money in your account, but this money does not belong to you. So you need to remit it back to the owner. Yeah. So now let's go to the second point. Second bullet. We're in page 34. Amount collected on behalf of the third party, such as sales tax, VAT, are not economic benefit and therefore are excluded from the revenue. Similarly, in an agency relationship, revenue is the amount of commission. Are you getting that? Similarly, in an agency relationship, revenue is the amount of commission. And the amount collected on behalf of the principal is not what? Can you write in bracket? It's a liability. But while you are the one having it, it's a liability. Good. So measurement of revenue. How do we measure revenue? Now, revenue is measured at fair value of consideration received or receivable after taking into account amount of any trade discount. In short, is the fair value. The amount the customer is supposed to pay, you after factoring in the discount. That's how we recognize that. Now, IAS 18 shall be applied for accounting for revenue arising from the foreign transaction. 1, sale of good. Number 2, rendering of services. Now, for example, what am I doing now? I'm offering the service. I'm not selling you the goods, right? Yes. Yeah. Now, revenue should be recognized if the following conditions are met. When should we recognize an income? Number 1, when the amount of revenue can be measured reliably. Number 2, it's probable that economic benefit associated with the service will flow from the entity. Yeah, when you expect an economic benefit. Number 3, when the stage of completion of the service at the end of the reporting period can be measured reliably. And then the cost incurred, the transaction, and the cost to complete the transaction can be measured reliably. Right in bracket, cost of sales. Cost of sales. Yeah, for you to make a revenue, you had incurred some cost. Those are what we call the cost you incur in the process of generating the revenue. Good. Then there is other form of income, that's the interest, dividend, and royalty. Revenue from the above sources should be recognized on the following basis. When should we recognize interest? Interest shall be recognized using the effective interest rate. Now, effective interest rate means the current market rate. In case of a royalty, shall be recognized on accrual basis. Accrual, that means you recognize when earned, not when received. And in case it's dividend, when should you recognize a dividend? Dividend shall be recognized when the shareholders have right to receive. When the shareholders have right to receive. Then we have revenue from contract with customer. That's under IFRS 15. Now listen up here. Now, revenue from contract with customer. For example, we did IAS 11. I want to use those terminology of the standard. I told you that standard need to be at your fingertips. The mode of setting the exam have changed. You need to be familiar with this standard. What was IAS 11? Yeah, long-term construction mnamalizia vizuri contracts. Yeah, we did long-term construction contract. That is that these are contracts which takes more than one financial year. Yeah. Now, if you're given a tender, most of you are business people, right? You are given a tender maybe by a school to supply food or the government. Do they pay up front? Kama hujui mambo ya tender unyamaze. How do the tender work if you're given a tender? For example, you are given a tender to construct a road or to construct a mansion. How does tender work? Or for example, you're given a tender by a given university or college or high school to supply food products worth 1.2 million. How does it work? The maximum they can give you is maybe like 10%. Then you deliver the goods or you offer the services. Then once you are done, they take like 1 month, 2 months, 3 months before they pay you. So that means before you apply for a tender, first of all, they have to assess your financial muscles. Are you getting it? Because if you're given a contract to construct a road, it's upon you to look for funds. Not the contract, not the owner. Once you are done, now that's when they start paying. Now, assume you are given a contract for example, 1 year. Now, when should you recognize the revenue? This one you're not generating from day-to-day operation. So now that's what now this regulates under IFRS 15. Revenue from contract with customer. Now, IFRS 15 describes the following principal steps to be applied to all contracts with customer. So what are those 5 steps? 1, identify the contract with the customer. It's all about the identification of the contract. How do you identify this a contract? 1, a contract with customer will be within the scope of IFRS 15 if the following conditions are met. 1, the contract has been approved by the parties to the contract. That means there was a mutual agreement between the contractor and the contracting. Number 2, each party has the right in relation to the goods or services to be transferred. The payment terms for goods and services to be transferred can be identified. And then a contract has a commercial what? So there must be an economic benefit. It's not a pro bono work. Number 2. So that was the first principal step, identification of the contract with the customer. Number 2, identify the performance obligation of the contract. So here there is a contractor, there is a contractee. Everyone will have to know their obligation. If I'm the contractor, I'm to do the work. If you are the contractee, the boss, your obligation is to pay me. So in that case, there must be, you identify the performance obligation of the contract. Good. Then number 3, determine the transaction what? Right, that one most sometimes you agree in advance. Number 4. Another step, you recognize revenue when all the entity is satisfied a performance obligation. Now that means when you're given a contract, even if you have agreed 10 million and you have not offered any service, don't recognize any revenue because you have not offered any service. And then number 5, how should you now recognize the revenue? Revenue is recognized as the contract is performed either over time or at a point of time. And mostly use what we call the percentage of completion method. Percentage of completion method. So you recognize the revenue based on the percentage of completion. And what are the criteria to be met for revenue to be recognized with reference to stage of completion? It's the same, the one we have discussed about when should you recognize the revenue. 1, that the amount of revenue can be measured reliably. Number 2, that is probable that an economic benefit will flow to the seller. Number 3, the stage of completion at the reporting date can be measured reliably. And number 4, the cost incurred or to be incurred can be measured reliably. But now we look at IAS2. IAS2 is all about inventory. Inventory is what you call the stock. So that's under IAS2. What is inventory? Don't tell me stock. What is inventory? You know, that's the problem with accountants. Eh? Explanation is the problem, but they can be able to account for it. What is an inventory? Is a current asset. But that was not the question. The question was, what is an inventory? Yeah, is any asset held for sale? Or the company held for trading or for sale? Good. So you're saying that inventory are assets held for sale in a normal course of the business, in the normal course of business. Administrator, how do you recognize inventory? As part of what? Current, huh? And now let me ask you a question. Is a motor vehicle an inventory? Kuna mtu amekataa kabisa. Is a motor vehicle an inventory? That means if you put it as an inventory, you put it as part of current asset. Is it? Let me ask you another question. Is land an inventory? It seems most of you have not understood what we mean by inventory. What is inventory? Asset held for sale. Now, for example, if you go to Maridadi Motors, their work is to sell cars, right? So that means what they held for trading is what? The motor cars. So that means to them, that one is not an uncurrent asset. That's the current. The only motor vehicle they'll classify as an uncurrent asset is the vehicle that's owned by the company to be used maybe by the staffs, because they expect to be in the business for more than one financial year. Let's go to Optiven. What do they say? So to them, their stock, their stock is what they are holding for sale. So stock here on shamba. Not unless the piece of land where they have situated their offices. But in case they are holding it for sale, to them is the what? It's the stock. It's an inventory. How can we understand what we mean by stock? Are you together? Now, it's any asset that is held for trading. Good. So you're saying that inventory are asset held for sale in the normal course of the business. In the normal course. They include raw material, work in progress, or finished good. Inventory also include material and supplies that are consumed in production. The objective of IS2 is to prescribe the accounting treatment for inventories, that is, the amount of cost to be recognized as an asset and carried forward. Units that are related to the revenue are recognized. So how do we measure inventory? Now, this is how we measure inventory. Measurement of inventory. If, for example, you buy some stock, you buy stock worth 20,000. That's the amount of cost you paid. Then you incur some costs, such as branding costs to rebrand those stock so that you can have your name on it. Also some transportation costs. So there was other direct cost incurred. Let's assume. So now when recognizing the value of your stock now, you'll not recognize an amount of 20. Recognize an amount of 20? So you're saying that inventory should be measured at the row of cost and net realizable value. The cost shall comprise one, the cost of purchase. Now, in this case, is our 20,000. Number two is the cost of conversion. This comprises of direct labor cost, variable production overhead, and fixed production overhead. And then number three, admin cost, selling cost, all those, the costs incurred in the process of generating that revenue. So that's how you measure inventory. Good. Then what are the disclosure requirements? What are the disclosure requirements? Yeah, these are standard. So for every standard, when you're preparing the notes to the financial statement, there's something you need to disclose. One of the disclosure requirements is what? Don't look at the notes. There is something I tried to insist here as class. Yes, Kaiser. Correct. One of the disclosure requirements I told you don't forget is what? Accounting policy. Whenever they ask about disclosure requirements, you have to show the accounting policy. Msiandike mara ya tatu, kwa hata hiyo ingine mliandika na mkumbuke. So sasa jaribu kuandika at point, you forget also. Whenever they ask about the disclosure requirement, number one is the accounting policies. Good. So one of the disclosure requirements is the method adopted to determine the cost. Now, this one you have done, or you do it with Mr. Royals in management accounting. We have various methods of inventory controls, or how you can use to measure inventory: FIFO, LIFO, weighted average. How do you mean by FIFO? Correct. I see you. Okay. Then number 2, the carrying amount of inventory suitably classified into raw material. Is it a work in progress or is it a finished good? Also, you need to classify inventory that are valued at net realizable value, because when preparing the financial statement, now, for example, if you buy stock worth 22,000, that's what you paid and what you incurred. At the end of the financial year, you need to determine the value of inventory as a current asset. How do you recognize them? Inventory shall be recognized based on the row of the cost, which is 22,000, that's the cost, and number 2, net realizable value. If you have to sell that stock now, how much can you fetch from the market after excluding all the cost of selling? That's what you call the net realizable value. So shall be recognized based on the row of goods. If you use the cost, that one is very understandable. You don't have to explain to someone. But in case you use the net realizable value technique, you also have to disclose that. That's why I think that number 3, inventory that was valued at net realizable value. Then number 4, circumstances leading to written down of inventories to net realizable value. Also, inventory pledged as what? Security. In some company, they do that. Also on an individual capacity. Have you ever seen asset to get a loan? You take your television, you get a loan. Once you pay your own, get back your television. The same happen with the company. Sometimes they can pledge their stock as security. Then number 6 is the accounting policy of inventory. Good. Then the next subtopic is income taxes, IAS 12. That one we discussed. You remember what's deferred tax, right? Temporary difference. We see that there are 2 types of temporary difference. Which one and which one? Taxable and deductible. Now, before we do that, I want us to look at April 2022. No, 2024. April 2024, question 1. Told you that this theory will carry a minimum of 20 marks. So it's between 20 to 35 marks. 20 to 35 marks. So now let's look at April 2024. Start with question number 1. You see, the entire question 1 is 20 marks. 20 marks. That's sitting at 28 marks. 28. So get 28, then you get one topic that you know and the published. You have passed. Question number 1. The objective of IAS 2 inventory is to prescribe the accounting treatment for inventories for various types of business organizations. Number 1, required. Summarize the key requirement of IAS 2 for manufacturing entity under the following heading. 1, scope of the term inventory. What do you mean by inventory? Asset held for in the normal course. I gave you 2 marks. Number 2, measurement of inventory. How do you measure? Have I given the measurement? Yeah. Okay. What am I trying to explain here? Because even the crew is here. That inventory is measured at the row of cost and net realizable value. Or also, you can try to explain what makes the cost of an inventory. The original cost, cost of selling, or that cost of conversion. Get your 3 marks. Number 3, disclosure requirement. Number 1 is what? They are given you 6 points. Those are 8 marks. Now let's go to part B of the question, part B. Highlight 4 categories of expenses that should be recognized in the financial statement of profit or loss in accordance with IAS 19, employee benefits. We did employee benefit as a topic, right? Yes. And we even answered this question, this specific question. I had told you to open that question. Do you remember employee benefits? Yes. Classification of expenses. One, you see that there is current service cost, past service cost, loss on curtailment, including the interest expense. Those are another 4 marks. I told you that for you to pass, you just require to remember what John Mark was saying. Simple. Just require to remember what John Mark was saying. If you can't remember, you are done. Number C. IFRS 15 is about what? IFRS 15 is about what? Huh? It's already here. Revenue from contracts with customers. Now, IFRS 15, revenue from contracts with customer, specifies how and when an entity will recognize a revenue. The standard provides a single principle-based 5-step model to be applied to all contracts with customer. 5 principal steps. Describe the 5 steps model. Don't describe, just state. Number 1 was to identify the code. Then you follow the other 5 steps. Number 5, number D. With reference to IFRS 9, what was IFRS 9? Financial instrument. With reference to IFRS 9, financial instrument, explain the requirement for derecognition of financial instrument. You said, what is derecognition? You said, what is derecognition? Oh, to stop recognizing, eh? That's very correct. The recognition is to stop to recognize or removal of a previously recognized. Why should you recognize an asset? Yeah, when there is no expected economic benefit from that. Number 2 was what? On disposal. But remember, okay, that's correct. But I mentioned too, there is the recognition of a tangible asset. And you see that when you recognize, 1, on disposal, when you transfer the ownership. Number 2 is when the asset is obsolete. That means you don't expect any future economic benefit. But in this case, they are very specific. It's all about the financial instrument. Let me give you an example. You see that a financial instrument is a financial contract that gives rise to an asset to one party and a liability to another party, e.g. a bond or shares, equity. If you buy government bond for 3 years, you invest in government bond for 3 years, what will happen after 3 years? You get back your money. So what does that mean? If you get back your money, is it still an investment? So in short, you recognize a financial instrument, number 1, upon maturity or when the contractual rights to receive cash flow have expired. When the contractual rights to receive cash flow have expired. Number 2, you had some share of a given company. So if you buy share of a given company, so 2 is a what? If you buy shares of a company, 2 is a what? Okay, what are we discussing? Financial instrument. What's the financial instrument? It's a contract. Yes, it's a contract that gives rise to an asset to one party and a liability to another party. Now that's what I'm asking. It's either an asset or a liability. You buy shares of a company. So 2 is a what? Asset. Now, when will you remove it from your financial statement as an asset? That's what called derecognition. If you decide to sell those shares, you sell it to someone else. Will it remain to be an asset to your asset? No, I'm trying to give you a point. Which point is? Yeah, said when you transfer the ownership. Yeah, on disposal or transfer. You know, you're acting like you don't have in your notes. Can you open your hand? Go back to your hand. Handout page 23. Handout page 23. Handout page 23. Hoping you are there. Now, page 23, there is measurement and recognition of financial asset. There is initial recognition, subsequent recognition. Now, before you read, I want to see whether you remember. How do we recognize financial instrument initially? Article that you get a 0. Me, I never mentioned cost. Cost, we say that it's for the tangible asset. That is investment property as well as PPE. And I tried, this is what I consumed a lot of time trying to explain financial instrument. That financial instrument will be recognized initially at fair value, plus or minus. The fair value changes either through to P&L or OCR. Subsequently, you recognize them still either at fair value, plus or minus fair value through P&L or OCI, or at amortized what? Cost. Yeah. On the same page, page 23. Can you see the recognition of financial instrument? Yes, the recognition. The recognition is the removal of a previously recognized financial instrument from entity's balance sheet. When should you recognize? A financial instrument should be derecognized if either the entity contractual right or asset cash flow have expired. Can you write in bracket maturity? Yeah, when the contractual rights to receive cash flow have expired, that means it has matured. Yes, at least online students, they know what is going on. Eh? Yes, for them, they are correct in most of the answers. Eh? They are copying. Eh? Another one is the asset have been transferred to a third party along with the risk of ownership. Can you write in bracket? Disposal. Simple. You have another 3 days to forget again. Then I ask you that question again. Yeah. So you see, like question 1 purely was 20 marks of the asset. And also there was another, the same thing. There must be other theories. Yes. Question 4A. With another 8 marks. I told you that this small topic of accounting for asset liability can make you pass or can make you an opening stock. So we have done with it's not bad to become an opening stock, is it, man? So page 35, income taxes. I think we have done that one in class. Page 36, recess. Did I do it in class? Yes. Correct. I'm almost done. Then page 41. Let's go to page 41. We discuss on bottom up. I mean triple bottom line. Triple bottom line account. No, me, I'll say triple bottom line. Eh? So what do you mean by triple bottom line of accounting? Now, this is what we mean by triple bottom line. Let me explain. Eh? It's an accounting concept or a reporting concept which requires company not only to focus with profit, they should also focus with other elements, such as environment where they operate, as well as the people they work with. So that means it's a reporting standard, reporting technique, which requires the accounting or classify the accounting into 4 dimensions. That is financial aspect. That one is mostly to present the profit or the asset base. Another one is social. That's the people. Number 3 is environment. Environment or the planet. Financial or the profit. I hope you have seen that. Even where you operate, you can be having a good company that's working well, even the profit are too high. But how that company, you go to internal affairs, how they treat their employees, that's why they drew the right. Are you getting? We have some company, they are making a lot of profit, but the effect they are bringing to the environment or to the community, air pollution, contamination, their waste directed to the river. I hope you're getting what I mean. Eh? So that means these are the triple bottom line. It requires that apart from showing us what you're making as profit, show us how do you treat the people you work with? And number two, how do you integrate with the environment around you? So that's what we call the triple bottom line. So we go through that, saying that triple bottom line is an accounting framework that incorporates 3 dimensions of performance. One, social, that's all about the people. Environment, that's the planet, as well as the financial, that's the profitability. The concept behind the triple bottom line is that companies should focus as much on social and environment issue as they do on profit. And I think if we can be able to do this, we can make this world a better place, whereby the people who are helping you to make cash flow, to make the profit, also try to make their life better. See, because that's what you are employed to do. Try to create a good environment. Be friendly to them. Sponsor them even for education. We have some companies which they have good bosses. If someone is running, they pay for your school fees until you finish. So you as an employee, how do you feel? So you feel motivated. Sometimes organize the party. If the improvement, the performance was good, just call them, give them a talk, and then you tell them, now I want to give you a gift hamper for the end of the year party, or we shall have, that one changes the culture. You go, you see, okay, by the way, we can be able to change this world, but it's all about the leadership, treat people better, and that's why I like how the developed country they treat the employees, because an employee, that's why you'll hear that in some countries, developed countries, a janitor, I've ever interacted with a janitor, so janitor, gardeners, you see that in developed countries, those people are able to afford their own homes. How? Have you ever had someone who is employed by UN? But how they are living their life, you wonder how. Because for them, the manpower is very valued. Now let's come to our Africans. Africans, we value property. You need a very big office. But someone who is working in that office, you want to give them a peanut. So why don't we capitalize on the social, or human capitalization? Give them good education, sponsor them, give them good salary, motivate them. But here you pay an office very expensive. But when an employee asks for something that is fair, I don't know whether you are getting it. Okay. Sometimes it's not about, and then also the peace of mind. Respect these people, because those are the people that are helping you to generate what? Revenue. That's how the people know you. That one is so. We have the people, for example, I have a friend who works, but how they interact with their bosses, it's like a community, it's like a family. It's like a family. But you have those with big salary, but they cannot get peace in the offices. So that means it's a struggle after struggle, because in an African way, for those who are working, you spend 75% of your life working, 2 of us. So, and if you are not working on a good environment, what will happen? I'm getting. Yeah. So when you become bosses in the future, let's try to make our world a better place. Siwe unajilipa kila kitu profit, but the people who are trying to help you to make that, you don't give them good remuneration. Try to give an impact where you operate. Ita mmoja, wewe mtoto wako anakwambia mimi mtoto wako uko shule, try kumlipia hata kama ni mwaka moja. Do you know how that person feels? Kuliko you are the boss, hiyo pesa yote unapeleka kuiva on a one weekend. But that money you could have impacted, have a social impact for one of the person, you change a generation. Anyway. So that was the triple bottom line. Now lastly, I want to look at IS 21. Now IS 21 is all about the effects of foreign exchange. Rates. This one I don't want you to use the handout. I want to summarize them. Now, what happens if, for example, you have a Kenyan company, and this company has a subsidiary or branch in another country, let's assume in Rwanda. We have a branch in Rwanda, but the parent company is in Kenya. So that means the company in Kenya will recognize or they present their financial statement in Kenyan shillings. What about our branch that is in Rwanda? They present their financial statement in the local currency, which is Rwandese franc. Are you getting? Now, at the end of the reporting period, remember now we need to combine the total sales that we made from our Kenyan market plus the Rwanda market. But you see now, the financial statement for the Rwandese branch has been recognized in Rwandese franc. So you as an accountant, first of all, you need first of all to translate the Rwandese franc to Kenyan shilling. You're getting my concept? Yes. Now the question is, how do you translate financial statement? Also, you have some business that are operating here locally. But for example, if you receive an international tourist who has only dollars, will you tell them, can you go and convert, then you come back? No, they can also pay in dollars. Now, for example, a foreign student, those who are paying for CASNEP, they pay always in dollars. Now, as an accountant now to CASNEP, how would you account for that? Because there are students who are paying in dollars. How do you account for that? So now that brings all about the effect of foreign exchange rate that is provided by IAS 21. It's all about how do you translate the financial statement or how do you translate the foreign currency. And in case there is any exchange movement, that is an exchange gain or exchange loss, yeah, can either be recognized as an income or an expense. An expense. So in such case, IAS 21 provides for two methods of translation. That's what I want to explain. Don't look at the notes. Let me just summarize them here. We have two methods of translation. One is the temporal method, also known as the functional currency method. Number two, is the closing rate. Closing rate, also known as the presentation currency method. So those are the two methods of translation. What's the difference? Now, the first one, the temporal method or the functional currency method, this one is the dependent branches or subsidiaries. So we'll come later to discuss what we mean by subsidiaries, and we'll be doing our last topic of consolidation. Then for the closing rate or the presentation currency method, this method is adopted if the branch or the subsidiary that has reported in foreign currency is operating with a degree of autonomy. So it's independent branches or subsidiaries. So that's the difference. Another difference is on the mode of translation. So for temporal method, how do we translate? Number one, all the income and expenses are translated using the average rate. Then number two, all the monetary items are translated using the closing rate. And then number three, non-monetary items are translated using the spot rate. Yeah, so all the income and expenses, in short, we're talking about all the P&L items, they should be translated using the average rate. How much was the average rate for the year? Then all the monetary items are translated using closing rate. Now, closing rate is the rate at the reporting date. For example, if the financial year ends on 31st of December, how much was the rate at that date? That's what we call the closing date. Then on monetary items be translated using the spot rate. Spot rate means date of transaction. For example, you acquired a motor vehicle when the US dollar was exchanging at the rate of 135. So that means when recognizing that item, you recognize at that rate 135. So therefore, what's the difference between monetary and non-monetary items? Now, monetary items include all assets, current assets, except inventory, as well as all the liability. And that's what we call the monetary item. Current asset except inventory and all the liabilities, be it non-current liability and the current liability. Therefore, what is monetary item? Non-monetary item. Non-monetary items, they are items that are not monetary. Which are those? I repeat again. Non-monetary items, they are items which are not monetary. So, you see, if you take the current asset except inventory and all liability, what are you remaining with? Non-current asset as well as the equity element and the inventory. That's what we call non-monetary. Monetary, they are current asset except the inventory and all the liability. Non-monetary, they are all other items that are not monetary. Crossing rate method. What are the mode of translation? This is the mode of translation, number one. Also, all the income and expenses are translated using the average rate. Yeah, both methods are the same. For the income and expenses, use the average rate. Number two, all assets and liabilities are translated using the closing. Number three, all equity items are translated using spot rate. So the difference is all about, for the temporal, it's all about monetary and non-monetary. For the closing rate, it's all about assets, liability, and the equity. So here, income and expenses is the same. Use the average rate for both methods. Then all assets and liability, we use the closing rate. And then all equity, I use the spot rate. And in case there is any exchange differences, be it an exchange gain or an exchange loss, should be dealt with to P&L immediately. That means either as an income or as an expense, as an income or an expense. Good, and I think I have explained everything. So what I can advise you, take a screenshot of this. Take a screenshot of this. Good. I think I've summarized that. So now let's go to page 43. You look at the last bit. The last bit is all about conceptual framework. So that one you go through. That one is not about the standard. So that one is very simple for you to understand. Yeah. Page 43 of the handout. Conceptual framework. Now, conceptual framework has been defined as coherent system of integrated objectives and fundamentals that can lead to consistency and that prescribe the nature, function, and limit of financial accounting and financial accounting system. Is the whole accounting system. And what are the useful of conceptual framework for financial accounting? So that one is something you can be able to digest. Let's go to page 44, the other page. Yeah, so there is framework for preparation and presentation of financial statement. That's IASB framework. Now, what do you mean by IASB? So that's the International Accounting Standard Board. Yeah, those are the ones responsible for developing a standard. That's the board. Yeah. So The framework deals with this, all the scopes, so I have explained everything there. Then I've given you the qualitative characteristic of a good financial information, also limitation of IASB. Then also I've given you the procedure in developing IFRS standard. How do they come up with a standard? Inapelekagwa bunge. Go to the first reading, second reading, all that consultation. Yeah. Then I've given you the element of financial statement. I've defined for you what's an asset, what's a liability, and what is an equity. From there, what follows is now what we have already covered in class. A long-term construction contract. Also, the other one is employee benefit. In short, everything that we have already now covered in class is well sorted there. Apart from FSC, that's the financial statement analysis. Now, kindly I urge you, accounting for assets and liability, I'm the one who have discussed. If you want to pass the FAR, kindly start studying those theory as early as possible when the knowledge is still fresh. Try to go through it. Then next month also, or in 2 weeks' time, try to go it through again. And then try to get those done. At least now you have crammed one disclosure requirements. You see, why did you understand that? It's all about repetition. Are you getting? And that's why we told that practice makes perfect. If you just read once, you'll understand because I'm the one teaching here. After 2 days, what will happen? You see, most of the item we had already forgotten. And it's barely how many days? 3 days. 3 days. Barely 3 days. What will happen after 1 week? 2 weeks? 3 weeks? Even if the other which unit is this? So even you can go and consult. Let me tell you one thing. If you take that your past paper from 2014, any theory that has been tested is already in that handout. Any theory that has ever or has been tested is there. Also, the theory that you will get, which will be between 25 to 35 marks, it's already here. So I'm telling you where the exam is. So it's upon you to make a decision on how to do that information I've given you. That even the exam to come, the solution, they are there. So it's upon you to determine what to do with that information. I wish to stop there for today. Now, our next session, I repeat again, our next session, code reading, will be one of the major topics. Everything we have learned combined into one. So that means it will be testing the concept of IFRS. You do working, you present. Financial instrument, you do, you present. IS2, you do, you present. IS19, and that is published financial statement. If you miss the first class, don't come for the second class, because you will float automatically. Or in case you know that you'll miss, before we go to the other class, the second class for that, make sure you have used the pre-recorded video before then, because it will totally be floating. So kindly purpose to attend the next session. And in case you know you'll miss, make an effort. Before the other session, you go through what will cover. That's enough.